Investing. We've all heard about it in many conversations, but what actually is it? Investing is the action of using your money in a way that earns a return and grows in value. There are many ways of investing. You can invest in education, like a degree, that will help you get a job and earn money to pay off the initial investment. You can invest in real estate by buying a house and fixing it. If you hold it for many years, it can increase in value. You could invest in a juicing machine to produce and sell juices. And then we have the type of investment that comes in financial securities or instruments like stocks and bonds. These financial instruments have specific rules and aspects that let you make a return. The return is the money that you earn on top of what you have invested. For example, if I invest $1,000 today and I earn a 10% return in a year, I will have made $100 extra from my initial investment of $1,000. Usually the return is not guaranteed as in other investments like a savings account. For example, if you have a savings account that gives you 1% interest per year, the return of 1% a year is guaranteed by law. With other financial instruments like stocks, this is not guaranteed, and the return is actually calculated by the performance of the stock. For example, if I hypothetically invest in a company's stock and they have a great year of sales and results, it will earn money on my investment, as the stock price will increase because people are willing to pay higher and higher prices for this stock. However, if the company struggles to make money, or say it's caught in a corruption scandal, then I could lose money on my investment, as the stock price will go down. Time to talk about risk. There is a risk of losing money with investing. Some investments have a higher risk of losing your money than other investments. Usually the higher risk of losing money could mean that you could also have a higher chance to make a lot of money. This is the risk and return trade-off. For example, stock A could have a 50% chance to earn you a 7% return and a 50% chance to earn you a 0% return, while stock B could have a 50% chance to earn you a 15% return and a 50% chance to get you a negative return of 9%. If you wanted to earn a 10% return, you would have to go with stock B, as it has the potential to earn you that, while stock A doesn't. This is why diversification is such an important tool to reduce risk. Instead of putting all our eggs in the same basket, or all our money in one single security, we can spread out our money and invest in several instruments that have diverse risk profiles. Diversification can give us the opportunity to get exposure to other potential opportunities. I could invest in stocks from different industries and even different countries. So if we research and have a conviction that, say, India has an incredible tech growth in the next 10 years, my investment will potentially increase and have exposure to this market if I put money in Indian tech stocks. Diversification works best when your investments are uncorrelated. This means that they have an independent move from one another. For example, if you have all your money invested in oil companies, most likely these companies are highly correlated. So if the oil prices crash, the stock price of these companies will drop too. This means that the money in your portfolio will drop. You would have done better if you had a bit of money in oil stocks and then in other industries that are uncorrelated from oil, like technology. It is imperative to always take diversification and the risk-return trade-off into consideration when investing. So back to the title of this video. Why is investing so important? It will help us reach our financial goals like buying a house, taking holidays, or having the freedom to quit the job you dislike to pursue your passion without a burden. Investing is also incredibly important to fund our retirement. When you retire, you stop working and earning an income, so you need to make sure you have money coming from somewhere to pay for your expenses. Many countries have a pension system where part of the money you earn is saved and given access when you reach retirement age. It works like a savings account, but it's invested in a diverse portfolio of financial instruments so that it grows through time. Besides the retirement tool offered by your government, it's important to have your own retirement fund in case you don't have access to this tool. As an arbitrary example, you could aim to save $1 million by the time you reach the age of 65. Ignoring inflation and other investments, $1 million in your savings account would provide you with about $30,000 per year for your expenses if you live to the age of 95. To reach $1 million using your income starting at the age of 25, you will need to save about $25,000 a year, or $2,083 a month for 40 years. It is extremely difficult to save $25,000 a year, especially if you take inflation into consideration. For those who don't know what inflation is the increase of prices on all consumer goods. So if you have your money sitting in a savings account with 1% interest per year, but inflation is 2% that year, you're actually losing money and losing purchasing power because the cost of living is rising and your money isn't rising at the same pace. This is why investing is so important. It maintains your money's value against inflation, and on average, it grows your money more than in a savings account. Unfortunately, most people have a short-term outlook and don't think about retirement until later on in life. Here's where the beauty of compounding is introduced and will hopefully change your mindset. With compounding, your money grows at an exponential rate the longer you have it. For example, if you have $100 and it earns you a 10% interest a year, the first year you would have earned $10, giving you a final value of $110. In year 2, the 10% interest rate is now calculated with the $110, not the $100. This means that you could earn $11 in year 2, then 12, 13, and so on. This means that the longer you have your money invested, the much higher the return is. Most savings accounts have compounding or compound interest, but these rates are very low and I can't remember the last time I saw something over 3%. In addition, these rates are subject to policy changes by government and subsequently the banks. Investing has compounding too. This is how it works. Assuming you're trying to reach that goal of $1 million by the age of 65 and the money you invest gets a 7% annual compounded return, then if you start contributing at the age of 25 with this return, you need to contribute a total of just $5,000 a year or about $380 a month to reach $1 million by the age of 65. You'll notice that now we are saving over $1,700 less a month than we would without investing. But that's assuming we start early at the age of 25. Let's instead say that you start your investing at the age of 45, so you have less time to reach the $1 million goal. Your annual contribution will more than quadruple to over $24,000 a year or over $1,900 a month. And if you start at 55, it's going to be over $72,000 a year or $5,700 a month. This is the power of compounding, and it can be either your best friend or your worst enemy when it comes to investing for a certain goal. And that is the magic of compounding, or interest on interest. Contrary to popular belief, with investing we don't have to come up with $1 million out of our pocket. In our example, those $5,000 per year are a total of $200,000 in 40 years that come out of your pocket. Where does the rest of your money come from? Well, the assumed 7% annual return and the concept of compounding. The lesson that I hope you get out of this video is that reaching your financial goals is easier by starting to invest the earliest in your life as possible. The older you get, the more expensive it gets to reach your goals. I hope this introduction to investing makes a difference in your life that will motivate you to start managing your money wisely and keep learning about finance. If you're interested in using the investment planning tool that I used in this video for the examples, make sure to check out my Patreon to access it, or check out the video on how to create your own investment planning tool. This is Planet Finance. Thanks for joining me. Until next time, happy learning.